Hi everyone, let's cover my bullish and bearish Elliott wave scenarios on Bitcoin, starting with the bullish scenario where we are looking at a finished 5-wave impulsive structure to the upside in a wave 1, preferably a finished corrective structure in a wave 2, and now impulsive continuation to the upside. In this particular case, your wave 2 here is labeled as a sideways WXY complex structure. Wave W is a running flat, wave X a double zigzag, and wave Y a zigzag. Now if price would continue ranging here in between the boundaries of the high and the low, then alternatively this wave Y can turn into a triangle A, B, C, D, E, and only then do you move towards the upside in your wave 3. The invalidation for this scenario is price taking out the low here at 101.2k. The bullish but eventually bearish scenario is what you see here on my chart. This is a double zigzag, wave W, wave X, wave Y, and after wave Y you are looking for a bigger retracement to the downside. Now here wave X is labeled a little bit different. Wave W over here starts with a flat structure, then wave X is a zigzag structure, and then wave Y is a triangle, finished at the recent low at 102.2k. After this low, what we're then looking for in blue wave Y is a zigzag to the upside. So 1, 2, 3, 4, 5 in a wave A, then have a retracement in a wave B, and another 5-wave impulsive structure to the upside in a wave C to finish wave Y. We do have a little bit of resistance to the upside. Here we have the point of control of the all-time high range at 107.7k, and we have a daily naked point of control at 109k. If we then look at an alternative, then this over here continues the range sideways. So this again is a WXY. So it is a bearish structure in the end. Even though you do expect the all-time high to be taken, you're looking at this as a 3-wave structure. W, X, and then a wave Y, and then you get a bigger retracement down. So here we again have a zigzag to the upside in a wave W, but now your wave X is a longer sideways corrective structure. W here is a flat. Wave X in blue is a triangle, A, B, C, D, E. And now you're looking for a wave Y in blue to the downside. And in this particular case, we would then be looking for a flat structure. And that is mainly because of the price action that we had yesterday. This move to the downside can be counted as a 3-wave structure to the downside, but not nicely as a 5-wave structure. Wave Y can also be a zigzag, right? A 5, a 3, a 5. That was an option we had on the chart yesterday for this scenario. But with the price action yesterday, this move down here, we can't actually really count a 5-wave structure. 1, 2, 3, 4, 5 doesn't work because over here the high got taken. We also can't count 1, 2, 3. We don't have a 4 and a 5. So in other words, it looks very 3-wave-ish, which therefore then is part of a potential flat. Like A, you look for a B, and then a wave is C to the downside. Now after this wave C, you then finish wave Y, and therefore you also finish wave X. And then you look for wave Y to the upside, which then again has to be a 3-wave structure to the upside, a zigzag 1, 2, 3, 4, 5 in A, 3-wave B, and another 5 in a wave C. Your most bearish scenario is what you see here on the chart. Probabilities remain the lowest for this scenario as it has been already for quite a while. But basically what you're looking at here is a bigger flat. A, B is finished, and you look for C to the downside. And in this wave B, you then have a finished WXY. Now this wave Y in yellow is incredibly short in time compared to wave W, and also very short in price compared to wave W. So generally a minimum target for a wave Y and a double zigzag is the 0.618 trend-based fib extension taken from the start to the end of W to the end of X, which as you can see has not been touched. And if we compare these structures in time, then we can take a fib time from the start to the end of W to the end of wave X. And then preferably your wave Y ends at least after the 0.382, which clearly it didn't. It ended before the 0.382. So that lowers the probabilities for this scenario even before this whole range started. Now, if you do want to count it like this, then this has to be your wave 1. You need a wave 2 here and then a wave 3 down. At the moment, with the price action that we have, it is very difficult to end a wave 2 corrective structure at this particular high. So in this scenario, you actually need a continuation of this range to then eventually finish wave 2 at a later stage. Now, if price does move to the upside and touch the 886 here, taken from the all-time high to the low of your wave 1, is sitting at 108.3k, the probabilities for this scenario will decrease even more. If we then look at the CVD divergences, then on the 15-minute time frame yesterday, with all of the news-related stuff and executive orders and whatnot, we had a little bit of bearish CVD, which played out, price moving to the downside, creating some new bullish CVD divergences here, higher low in price, lower low on the blue and the yellow CVD line. In other words, there is absorption of market shorts with limit long orders, which supports price moving towards the upside. Also locally here, right, higher low in price, low CVD, and here a little bit of a bullish CVD. And that already played out. So price is just moving towards the upside. The target for this CVD would be taking out the high here at 106.8, 106.9k. The moment that divergence plays out, we have to be aware of the bigger bullish CVD divergences that are still active, with the target being the all-time high. Now, more local CVD divergences are always going to be the most important CVDs. So as price potentially then moves to the upside and this CVD here plays out, you take out the high, you just got to be very aware of potential new CVD divergences at resistance over here. And that is because of the summary, right, with regards to probabilities and polylines that I will explain in a second. Because first, I like to let you know that at 4 p.m. Central European time today, we have some high impact news. So I don't actually know what this is, but it's in my list. tradingeconomics.com/calendar is the website I use. Just make sure you trade safe at 4 p.m. today, Central European time, because it can increase the volatility. And if we then look at the probabilities and polylines, then the reason why keeping an eye on the local CVD divergences at resistance is because of the yellow and the blue line, where you are eventually looking still for a retracement before continuation later. And of course, if price would hit resistance and then reject lower highs and lower lows, supported by continuous bearish CVDs, that is important. Now, the probabilities from an Elliott wave point of view, on the 1 hour time frame here, the scenarios that take out the all-time high have a higher probability. The probabilities favor a double finished zigzag or a bullish impulsive scenario. So just to show this on the chart, the impulsive scenario is this one here, right? And the finished double zigzag wave X scenario is then what I mean. So this scenario here, those two have the higher probabilities at the moment. Slightly on the number 2 spot, close second, is an unfinished WXY. So we have W, X is not yet finished, and then a wave Y. The reason why the probabilities for this scenario are lower compared to the other two is because wave Y here is a flat, while wave W is also already counted as a flat. And the rule of alternation in Elliott waves is not only about wave 2 versus wave 4, but also wave WY. So if wave W is a flat, wave Y preferably is a zigzag or a triangle and not a flat, right? It is a guideline in the end, even though we call it rule of alternation. It's not that wave Y needs to be a zigzag or a triangle. It's just something you prefer to see. And the fact that wave W here is counted as a flat, preferably your wave Y is not counted as a flat. And that is done in this scenario here, where then your white Y, W flat, X, Y is a triangle. And in the bullish scenario, we have W flat, X, and zigzag wave Y. So that is the reason why the probabilities for this scenario and this scenario are higher, and then depending on the move up, we know if we're looking for a wave Y or continuation, bullish continuation impulsively. On the number 2 spot in probabilities is this one here, where you do look for another flat, and the lowest probability scenario is the bearish scenario. Again, so an impulse to the downside. There is no clear signs of weakness or very obvious reasons to pick this scenario over the others. So yeah, these are the probabilities from an Elliott wave point of view. I hope that this video was helpful or valuable to you. Please check out the CVD indicator video, the best indicator out there in my opinion, or the Elliott wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye bye.